Joining us, Johanna Chua, Citigroup's Chief Asia Pacific Economist, is with us on the program today.
Hi.
Johanna, hi.
Hi, good morning.
Good morning to you. So we were talking about all these storm clouds that we're facing in the global macro environment. You tell me, what are you seeing right now?
Well, obviously, the environment for risk is quite tenuous at the moment. And this, because of all that's happening at the moment, we're actually seeing it have some impact in economic activity. So the slowdown in momentum in the U.S., the slowdown in momentum in China, problems in Eurozone. If you look at all the export numbers out in Asia for the month of April, most of them have, actually all of them so far have been below expectations.
Yeah.
So obviously it's something that's going to be on the key headline issue for a lot of policymakers.
Okay, what have you factored into your estimates? Have you factored in a deeper than expected recession from the European side?
Okay, well, at the moment, we've already factored in a deep recession. I think, still around -1% or so contraction for this year.
Yeah.
We are still assuming...
1% is not exactly that deep.
Well, again, there's a lot of variation.
Yeah.
So the peripheral countries are going to be much, much weaker than the core. In the U.S., we've already been anticipating a sequential slowdown in the U.S. in second quarter. So some of the slowdown in economic data in the U.S., I don't think one should really exaggerate it, because I think people were overly optimistic with the sort of weather-driven positive data in the early part of the year. But the big debate is, at the moment, we're only factoring in that this is kind of a soft patch. That we have a bit of a slowdown in 2Q, but going into second half, things kind of normalize a little bit. But I have to say, given the political developments over the weekend, the downside risks have definitely risen.
This has definitely increased, especially with Greece. Okay, so couple that in with what took place in China. So we got the trade figures yesterday. Exports slowing, but CPI, bang in line with expectations, is slowing down in consumer price rises.
I think this pretty much tells you a picture in China where domestic demand is really slowing down. And I think a key factor in the trade data that came out is less that the exports disappointed, because it's not really a big surprise, but the fact that import growth really significantly surprised on the downside. Exactly. And I think if you look at the underlying components of that slowdown in import, it shows you that investment is really slowing down sharply. So today, we're going to see a lot of data, the industrial production,
retail sales.
Retail sales, I think, should be relatively more resilient, but the fixed asset investment component, that's something we need to factor in.
Yeah.
And with inflation pretty much, in close to expectation, but below the 4% threshold, I think that should give policymakers more room to do easing.
Yeah, you think,
soon.
right? You think.
Yeah.
And people are saying that it's more to do with the easing in loans, like the freeing up of credit, rather than cutting triple Rs and interest rate cuts this year. Do you agree with that sentiment?
Well, interest rate cut, I don't think that's going to happen. But I do think that since a lot of investment activity needs funding from bank credit, that a critical juncture of the way they do monetary easing in China is to relaxing credit. So it could be, I do think that triple R is part of that easing policy.
When are we going to get it?
Well, I hope soon. A lot of people have been saying this, but I think hopefully we should have another triple R cut, in the next couple of weeks. Maybe some potential, we've already seen some relaxation of policies, maybe hopefully an LDR. And fiscal, the use of a little bit more fiscal easing as well, and a lot more infrastructure investment.
Now, I wanted to touch on your expertise. So you're saying that China is slowing down quite dramatically. So couple that with what you just talked about with Europe and the U.S. Does this mean to you that we've seen the highs of the year and it's just going to get gloomier from here?
Well, I have to say that China is slowing down, but if you look at it from a year-on-year, we're expecting year-on-year growth will be the bottom in 2Q, about 7.9%. But on a seasonal adjusted annualized Q-on-Q growth basis, actually first quarter was weaker, because the year-on-year is pretty much base effect. So I would have to say that things were, a little bit bad on economic activity in the first quarter. Now, I'm hoping we get a little bit more easing. Have we seen the worst? It's a bit of a wild card because of Europe. A lot of risks in Asia is actually less so on, I'm less worried about China hard landing risk, because I think the slowdown is a deliberate policy of China. Yeah. And they could always tinker, and they have flexibility.
Hopefully, as you said, hopefully.
But no, I think they are. They are already starting to gradually ease. You can see it. But what's happening in Eurozone, I think the external risks, that's the wild card.
That's a wild card.
Here, I'll lead off with a question on these inflation numbers out of China. Right in line with expectations. What do you think they mean for the economy going forward?
Well, I think it pretty much means that there's monetary and policy space for easing in China, given that inflation is, fairly stable, relatively, well below what is the inflation threshold comfort level of about 4%. So hopefully, if economic data continues to show weakness, that should give room for a bit more easing.
Well, once the high base effect, sort of disappears as we move after July, do you think there will be more? It will show that real inflation actually.
Look, I think it will take a little bit of time for the base effect to reverse very sharply in China, because China also had very high food prices, if you remember, in July last year, around the third quarter. So there's a number of countries where the base effect is going to reverse much more dramatically, like Korea, Indonesia, etc. But in China, I think the base effect is a little bit later. And given the global environment, what's happening to oil prices, that's also something that goes in its favor.
How confident are you that to the extent the Chinese government does ease monetary policy, that is going to be a clear indication that there is going to be an increase in consumption? Because clearly that's the biggest driver. It's the biggest driver in terms of what they consume overseas, but also what they consume within that country. And that seems to be the biggest lagger. And to the extent that there is monetary policy, I don't see a direct correlation in an increase in consumption.
Well, first of all, I think the policy easing is not going to be just monetary. It'll be a combination of a lot of things, including fiscal.
Sure.
And actually, the biggest driver of growth has been investment in the last couple of years, and that's the one that's been slowing down. Consumption is something they want to encourage, and so far, actually, it's been holding up okay. And part of it is because, despite the slowdown, employment conditions have been very resilient. So income is still growing, people still have jobs, so consumption has been very, very good so far. Of course, there's still a lot more room to boost consumption, which I think requires more than just monetary policy, but a lot of structural policies for rebalancing.
Well, Joanna, what I want to talk about, right? About the political tensions, but more in the economic sense, because, David, we've seen market reaction, right, in the Philippines. But what about the economy? 1.3 billion people are being warned not to travel to the Philippines. I mean, is that going to have an effect on the economy?
Look, obviously it's very bad for the market and the sentiment, right? Now, the good news is that, Philippines, if you look at the structure of its balance of payment and its economy, the reliance on tourism and China tourism, of course, it's a very fast-growing segment. It's not that big relative to, what's driving the economy is services exports like BPO and remittances, right? And a lot of the remittances, they're not particularly concentrated from China. They're very spread out in Middle East and the West. So from sort of an economic vulnerability standpoint, I don't think that obviously, it's not that vulnerable, but obviously it has a big impact on sentiment.
Okay, so I'm trying to take a look at this dispute in an economic sense, if that's how you could talk about it. But when you're the Philippines and you're such a small economy going against someone like China, do you really want to battle over such a small territory in the South China Sea?
Look, personally, I hope cooler heads prevail, and I'm confident that this can be addressed diplomatically. So I don't want to sort of, exaggerate what would happen. But I think, at this point, that's what I'm hoping. That therefore, I don't think we're factoring into our forecasts what's happening at the moment.
It seems like with this dispute with Greece this week, we enter into a new phase of risk aversion in the marketplace. Just when we thought we could sell in May and go away, perhaps not. Do you see that? Risk aversion rising across the board?
Well, look, I think the Greece risk aversion is probably more important at the moment than the China-Philippines. But I don't know. Look, it's hard to tell because clearly with the Greek not able to form a coalition, you probably have to have another runoff election. It's not clear whether they're going to be able to form.
If we have another election, clearly the baton has passed to the third individual, and he has a 3-day mandate. Venizelos has a 3-day mandate. To what extent do you expect these elections to happen? And then, more importantly, what does that mean for China and here in the Asia-Pacific region?
Okay, well, the problem is, obviously, because of this delay of forming a government, then the ability for the Greek government to come up with enough austerity package, which the lenders, the creditors want, sort of a 7% of GDP equivalent budget cuts. How are you going to come up with a credible plan if you don't have a government? And so the risk is if this drags on, then the lending, the disbursals are all going to get delayed, and there'll be a lot of uncertainties.
Well, they got the disbursement, right? They got $5.4 billion. There's still $1.3 billion on the table, and the EFSF says, hey, we're not going to provide it until you actually understand, until we get a clear picture of what's happening economically, socially, and politically.
No, I mean, in fact, Citi has already raised the probability of a Greek exit from Eurozone.
75%.
50 to 75. We
I
have a
heard
range.
75% by 2013. Yeah.
But that's very high, right? So obviously, the key risk factor is how that's going to impact, contagion, and people are going to worry. Now, the good news, I think, for Asia is vulnerability standpoint. Right. A lot of countries, especially East Asia, is relatively more resilient. And one of the good things that actually happened recently, last week, which maybe wasn't reported very widely at the ADB meetings, is this Chiang Mai initiative that got expanded. So ASEAN plus 3 now have a $240 billion swap facility that gets used to India.
Yeah, we're running out of time, but I want to bring up the big talking point because obviously, you're at the trading floor in Citigroup, and I'm sure the big talking point is about Jamie Dimon and JP Morgan. I just want to read this quote from a big conference call that took place, and this has to do with the Q&A, basically, a really contentious Q&A between Mike Mayo at CLSA and Jamie Dimon. So basically, Mayo saying that would this be JP Morgan specific with this trading loss that we saw, or is there a chance that others will also have similar losses on similar positions? Well, Jamie Dimon, his response, he says, I don't know. Just because we're stupid doesn't mean everybody else was. I have no idea what other people are doing.
And I have no idea, too. If he doesn't know, I have no idea as well.
But what are people saying on the trading floors today?
I mean, obviously, everybody was very surprised by the news that came out, right? So...
But the bets have been going against the markets. The prices have been going against some of these corporate bonds that are linked to some of these esoteric trades, these derivative bets, for a month now. So was it really a surprise? I mean, I think the biggest surprise is that JP Morgan mismanaged the way they did it.
But the losses took place in just 6 weeks' time, so it's just the rapidity of the losses, and also it's a $100 billion book. I mean, right now you have $2 billion losses. People are saying that could be even bigger than expected, wider than expected. That's why you see the sell-off right now.
I like the way Diamond's talking about it. You know, he's using plain English. He's not trying to massage the situation. Mike Mayo, of course, probably a persistent thorn in his side. He responds and says,
the big question coming out of this is what does this mean for the Volcker rule, which will be in effect on July 21st, and to what extent are people are now assuming and speculating that what you're not allowed to do in terms of proprietary trading is now actually happening in the Treasury House. I'm not saying that's what happened to JP Morgan, but that's what I'm hearing across the floor.
Look, news like this obviously is, for the industry is going to have an impact, right? I mean, obviously the fact that you can have prop losses, I think that's something, and the view, the fear that banks are taking bets because they think, the asymmetric risk payoffs.
Sure.
I think regulation is obviously a risk, and this is not good for the industry.
It's down day for JP Morgan tomorrow.
All right. Thank you so much, Johanna, for dropping by. Johanna Chua, have a great weekend.
Thank you.
Of Citigroup.